funsupermart.com.
When People's Bank of China cut interest rates twice in just 1 month, markets took the hint that economic conditions in China may be worse than expected. Sure enough, 1 week after the second rate cut, second quarter GDP figures did indeed show a significant slowdown, with the second quarter GDP growth at just 7.6%. Now, while a 7.6% GDP growth does indicate a meaningful slowdown, some worry that the slowdown may be even more severe. So in this webcast, we'll take a look at a range of other economic indicators in order to further understand China's true underlying economic conditions. The Vice Premier of China also once agreed that the official GDP figures had its shortcomings. He claimed that electricity, rail cargo volume, and bank lending were better proxies for the Chinese economy. The recent electricity production trend does indeed show a worrying picture. Electricity production growth was much slower than GDP in the second quarter. In fact, the figure recorded no growth in June, even though electricity production has been slightly more volatile than GDP. During the period from 2002 to 2007, the two figures moved roughly in line with each other. However, from 2008 onwards, we found that electricity production was much more volatile than GDP. This could be due to government intervention, but nonetheless suggests that economic conditions may be worse than what the headline figures suggest. On the other hand, we can also take a look at some leading indicators such as PMI. Not only has the official overall PMI been declining in recent months, but its separate components also indicate weakness in different parts of the economy. Looking at export orders PMI, we can see that weakening external demand has put a drag on Chinese exports. The new exports orders PMI fell to 47.5 in June, then proceeded to drop to 46.6 points in July. A figure below 50 indicates that the industry is contracting. Looking at other PMIs, we can see that China's economic weakness does not only come from weak external demand. Inventory and stock of finished good levels have been rising, which indicates weakness in overall demand, including both domestic and external demand. New orders minus inventory is an indicator of upcoming additional output. Although the figure rebounded in March, it subsequently recorded a steep decline to 0.5 in July, which is much lower than its historical average. Stock of finished goods indicate the amount of finished goods producers still have on their hands. Although the figure exhibits volatility, there has been a clear overall upwards trend since the end of 2009. This figure also indicates that overall demand is weak. Considering that China has experienced a prolonged period of high economic growth, in the long term, growth will taper off to a slower pace as the country adopts a more sustainable economic model. However, this should not be a surprise. Therefore, we believe that part of it has been priced into the market's depressed valuations. But admittedly, growth has been slower and weaker than we initially expected. To reflect this into our analysis, we have taken a more conservative approach and lowered the Chinese equity market's fair PE level. Upside potential has been lowered as a result of the fair PE adjustment, but China's H-share and A-share markets' upside potential is still the highest among the markets in our coverage. Therefore, we remain our positive outlook on the Chinese equity markets.